Everybody, it's Anthony Fletcher. Thanks for coming to my channel. Today we're going to be talking about um, things to consider about when you're buying a rental property and maybe buying a rental property in another state. I had a couple clients and also one of your viewers, so thank you so much for the comment. And what we're going to do is talk about some different things that I know from my experiences about buying a property in another state. Now, I am not a licensed tax consultant, and I am not a licensed realtor and not an appraiser either. So for any of those type of things, I'm speaking specifically from my experiences and not telling you um, gospel there. So definitely talk to a realtor, your tax advisor, and also maybe an appraiser if you have questions that have to do with those license questions. So, okay, so let's kind of get into it. What I think is kind of important for you to kind of understand when you're buying a home in another property, there are some different financial implications and things like that that may be different if you buy in a different state than the state that you live in. And there's a lot of things to consider. So first of all, you need to consider about getting a realtor. I would definitely do so, mainly because you definitely want to try to find a realtor that is a buyer's agent and not a seller's agent. Now, seller's agent just deals with the listing. So a lot of times 90% of their business is done by listings, 10% is the actual being buyer's agents. Usually they're only buyer's agents if they're helping someone buy a new home that they just sold. Whereas a buyer's agent just works specifically through that. So definitely look for a buyer's agent, and you can definitely contact the board of realtors that you um, are looking at as far as in another state or whatever city you're looking at buying the property in. Also, you can contact your local realtor. So if you do know somebody is local that you would like to work with, then you can ask them for a referral because they do make some referral fee by sending you a referral to another agent in another state. And so that kind of works out good for both of you because they'll find you a qualified individual. Um, okay, so second thing is the type of home that you're looking for. You got to decide whether or not there's going to be a condo or if you want a stick-built house or a manufactured home or whatever. I would definitely think about a couple things out there. Is one, how are you going to be able to finance it? Because all of these, the condo, this thing, this rental thing, and this finance thing, all and the taxes thing, all kind of go together. And what I can tell you is you buy a condo, usually you can find one, in a much more closer location to exactly where you want to be. Let's say it's on the beach or something like that. Where a house, it might be a little bit hard to find a house that has for the price that you want, that has that view or has the amenities that you want to have, be right next to the river. And a townhome usually find a lot of those near golf courses. So, and same thing with that. But what you've got to be thinking about also is the CC&Rs. And the CC&Rs are basically, the restrictions that you have on the property. Maybe some can't be a nightly rental. So then you're going to be forced to make that as a, 12-month rental. Or, like we did with our houses, we don't have the ability in our neighborhood to have a nightly rental anymore. And because the city made some changes to the city, and they said basically couldn't have one within 250 feet of another one. So we have one about 6 houses down this way and two houses down this way. So um, it makes a difference. And if you do go nightly rental, you got to be thinking about noisy complaints. Um, Unfortunately, the nightly rentals that we have in our neighborhood, there's probably 5 or 6 times a year we have to call the actual property management company and let them know these people are being loud after 10 o'clock at night. So you might have to be worried about something like that. Um, Now with the house, you generally get a little bit more flexibility, but still you can still have that same thing. And like with a townhouse, you usually, those are really popular in golf courses. When it comes to furnishing then and Airbnb, okay, that's another thing you have to think about because Airbnb doesn't always make the amount of money. Back in the COVID times, the houses that were nightly rentals that were in our neighborhood were busy all the time. But this last year, they've been really quiet. Maybe they've been rented once, one weekend out of every six. So the property owner is charging $300 a night for those, $350 a night. So every month they may make, an equivalent of $500. Whereas the summer, we'll see what it's like. But last summer it was still only rented probably half the time. So they're not making the money like they would normally. My next door neighbor rents his property out for $2,800 a month. So he makes close to $36,000 a year, $34,000 a year off of that. And he has the house is spotless. He always has a really good renter in there. There's always quiet, and the home is kept immaculate by the renter too. So it's been a really good way of going for that individual by owning that property. So think about that, what you want. Do you want to have access to that property yourself? Do you want to use it? We had a property um, on the Columbia River about several years ago, and during the summer we could never use it because it was rented basically every single day. But when it came October or September 15th, it basically wasn't rented again until probably April again because it was so wintry and stormy and things like that. So we got to use it quite a bit, which was really quite nice. Um, so you got to think about that. And then when it comes to financing, now that's the big issue as far as you need to kind of be aware of this is one, when you finance, if you don't have a track history on an Airbnb, that means you have to have audited information. If you don't have audited information, you probably can't use the income, or if you've never been um, a rental owner before, you're going to need an underwriter that's going to allow you to use that income. So you got to do a really good job of creating that track history of that ownership. And if it shows that it's being run by a particular company and it's been run professionally for years, then you'll stand a really good chance of being able to use that income to help you qualify for the payment. And if it's a rental property, once again, if you do get somebody that's renting the property already, then you can immediately use that income to help you qualify for the loan. So that's really good. If you don't have that track history with this one, you're going to have a really hard time being able to use any income. And then you have to decide whether or not you want to have it furnished or unfurnished, because that makes a difference too when it comes to your special information. In my neighborhood, for example, um, like I told you, we don't have the ability to have as a nightly rental, but during the summertime, we rented our house out for 3 months. And during that time period, we made really good money from renting our property out from month to month as a full-sized home that was fully furnished. And people loved the house, and we make great money off of it, paid for us to go on vacation for 3 months, basically. And so, and then we come back and use it for the other 9 months. So if we do that over and over again, it's a pretty good way of doing it. Um, so another thing you have to think about is if you buy it to make it an Airbnb, for example, then you could probably buy the property and use it as a second home. You'll still get the same interest rates as an investment property. However, you may only have to put 10% down because you buy it as a second home and then you use it as an Airbnb some of the other time. Okay. Whereas if you go this rate as a straight rental, then you're going to probably have to put a minimum of 20% down, most likely 25% down to get a really good, decent rate. So think about that too, if that's going to be worth it. Now, one big issue is that you might want to be concerned about is the state that you're buying this property in is it a community property state, and are you married and living in a non-community property state? For example, we live in the state of Oregon, and it's a non-community property state. What credits my wife have, what credit cards and things like that are hers, and what are mine is mine. So if I go buy a property in my name, I'm only using my credit um, to for my debt to income ratio. So my total debts versus my total income. Whereas if I bought in Washington state, even if she's not on the loan, we still have to have her credit report pulled, and any additional debts that she has to have goes on to my um, goes on against my total debt to income ratio, because in the state of Washington, what is hers is also mine because of the community property state. So something else to take in consideration, also insurance. If you do buy a property and you want to make it a second home and use it as an Airbnb, that's great. Get like that type of insurance that you need there. But if you buy a home and want to make it as a full-time rental property, okay, and then um, you get insurance that says it's for a second home, then the underwriting team or the lender is going to either make you switch that to be a rental policy insurance or make this as a second home. Also, one other thing about it, if you do a second home, like we were talking about, is 10% down. The rates will probably be, like I said, about the same as they will be as a rental. So just be concerned about, that. But like I said, you'll get 90% down. You only have to put 10% down as a second home, which will probably be good for you. Okay, taxes, depreciation. That's the big thing when it comes to taxes when you do buy a second home. Is just real quickly, just kind of go what depreciation is that when you buy a house and it's investment property, you get to depreciate that asset over the course of the 30 years. And there's actually a depreciation schedule that your tax advisor will tell you what it's about. So here's kind of a little scenario how it works out in your benefit is that if you make $20,000 a year in income from it, and let's say that your mortgage interest is $10,000 and your expenses for property taxes and things like that are $5,000, and let's use a number of depreciation of $7,000, that can show as a negative $2,000. So it actually shows as a loss on your income. And so what that happens to do is it'll lower the amount of your total taxes as due over the course of the year. So when you do your taxes at the end of the year. So and then finally the exit strategy. From personal experience, I wish I would have kept every rental that I bought. First home that I bought, I purchased it for 78,000. We sold it for 102,000, so we made some money on it. 2 years later, it's now worth $500,000. Homes here in Bend that we bought and we flipped, we paid 160 and $140,000. We made good money on flipping those, but those are now worth about $500,000 as well. So if we would have kept that and kept them and just rented them out, they would have all been paid for now, and we would have been in a much better scenario than we are right now. But we're happy with the choices that we made. So you have to be happy with the choices we made, and think about this exit strategy when you're going into it, because it is an investment. Think of this at the time you're thinking about buying a property. What is your exit strategy? Is this going to be a house that you want to keep forever, or are you hoping to make some money on this thing and then sell it down the road? So there you go. There's some bunch of different things to consider, and I sure appreciate your comments. And thanks again for watching my channel, and we'll see you again in the next video. Have a great day, everybody.